Welcome to AEC Unscripted M&A Edition, your go-to podcast for unfiltered conversations and expert analysis. Brought to you by Stambaugh Ness.
Welcome to AEC Unscripted. I'm your host, Jeff Adams, the Director of Mergers and Acquisitions at Stambaugh Ness. Today, we're going to be exploring M&A through the lens of a couple of wealth management advisors. I'm delighted to have joining me for this episode, Brian McCarver and Jonathan Freeman from Stonebridge Financial Group. Stonebridge Financial Group is a financial advisory firm based in central Pennsylvania, focused on personal wealth management and retirement plan services. Stonebridge's specialties range from helping already established corporate clients create retirement plans to assisting business owners and institutions with financial planning. Hey guys, thank you so much for joining me today.
Yeah, thank you for having us. We're delighted to be part of this show and hope we can have some good information flow for your viewers.
Well, I think you guys bring a unique perspective to the equation here, and something that's going to be of interest, particularly to sellers. But I think you're also going to have some things that might be informative to buyers as well. So, looking forward to getting into it. Before we do, tell us a little bit about yourself.
My name is John Freeman. I'm one of the managing partners of Stonebridge Financial Group. I've been partners with Brian since January of 2002. I started my career in Boston on the trading desk at Fidelity in 1996. Was a trader for the first couple of years of my career during kind of the peak of the internet bubble, which was a pretty good learning experience. And after that, I ended up working in Manhattan, actually as a consultant to financial advisors as the industry was transitioning from more of a brokerage industry to a professional advice-based industry. And one of my clients was Brian and the gentleman that he was working with at the time. So I met them in New York City just before 9/11, actually. I experienced 9/11 from about 3 blocks away. And after that point, my wife was willing to agree to move to central Pennsylvania from the New York metropolitan area, which her parents are still not happy with me 23, 24 years later. But we're thrilled to be here, thrilled to be in central Pennsylvania. And again, Brian and I started working together in January of 2002. And we worked for an existing practice with a large corporate retirement plan focus. We were hired kind of to do the wealth management and financial planning part of the practice. Eventually ended up taking over the practice in the 2006, 2007 range, just before the financial crisis of 2008. But we got through that time period and ended up taking our business from a what they call a wirehouse, which at the time was Wells Fargo Advisors, into the independent financial advisory world, and eventually into our own registered investment advisor in 2024, actually, early last year. And since we have created our own registered investment advisor, we have actually established a couple of different business lines, including payroll services and also buying into a Medicare insurance brokerage firm very recently.
Awesome. So you said, I heard you say you started out in Manhattan, so now you've kind of moved, I guess, to a little bit slower pace of life.
I thought it would be, but but no, it's. I'd say it's roughly the same pace around here as it was in Manhattan. There's just less traffic.
Yeah. Brian, tell us about yourself.
Yeah, good morning. Thank you again for having us. I spent my early parts of my career serving in the military and decided to move back into this region where I grew up. My wife and I met in high school. I took her not quite around the world, but to Europe and back again. And now we arrived back in South Central Pennsylvania to work in this industry. I, like John, have very similar roles in the company, but as he said, I do more practice management, business management. John does a little bit more client development work on the outside. But we've built a great firm, largely because we've hired great people. John and I realized pretty early that we weren't going to be able to do it all ourselves, and we were fortunate to cross paths with some really influential team members who helped us grow and expand the practice. I think, at least in our definition, the right way, we have succeeded in growing, well into the double digits for multiple years. Our assets under management / advisement are close to $2 billion now, and they just keep growing and improving, and the business starts to kind of help feed itself almost at this point. So we're very fortunate.
What does the ideal client look like for you guys?
Oh, good question. Well, I think about that because when I started in the business, I thought I knew who that was, but really what it comes down to is somebody who has a desire to engage somebody and receive advice. That might be too simplified, but in reality, there's a group of the investing public that doesn't choose to work with an advisor, and we have formulated a lot of relationships with clients that just value the input that we have. Finances today are, I think, in some ways simpler, but in some ways a lot more complicated when you start considering taxation, et cetera. But yeah, I would say a client who has some wealth to manage and a client who's looking for advice and seeks to engage us in tandem with their other professionals or CPAs or attorneys, et cetera.
Well, I think that fits in very well with our audience here today, that with architects and engineers. I mean, their services are similar, right? They're looking for people who are looking for advice, seeking advice from experts.
Yep.
And so they can pretty much appreciate that answer, I would think. So, uh, we're going to be talking a little bit in the context of mergers and acquisitions today. I mean, it's AEC Unscripted, M&A Edition. So, what has your firm's involvement been with mergers and acquisitions in the past, as far as individuals who have gone through M&A or what have you?
I would say our involvement is largely preparing our clients prior to sale. I'd say most of our highest net worth clients probably were business owners at some point. And a big part of our role is really to help them understand what they need out of their business to retire and to maintain their standard of living. So, doing those types of projections up front is very, very important. Often our involvement begins through the corporate retirement plan consulting. So obviously we tie that consulting into their projections along with obviously the eventual business sale. And, other flow modeling and helping to kind of define the minimum that they need from the sale to achieve their goals. We would really try to help with the tax planning along with the CPA. I mean, we really think that input from the CPA is critical prior to the sale to understand how to maximize the net results of the transaction, not just the gross results of the transaction. The other part of our conversations with clients very often prior to sale is from an estate planning standpoint. So it's not just preparing for their retirement, but it's understanding how they want this to impact their estate goals, including the possibility of some, gifting prior to business sale, potentially at a discounted value.
I appreciate that context too of how you get in and help prepare people for what they're about to experience with M&A. And I'm thinking particularly with sellers, right? Because the sellers are the ones who are suddenly going to, or maybe suddenly find themselves with a load of cash that gets dropped in their plate. And now it's like, well, what do I do with this? And being prepared for that, being prepared for it from a tax standpoint, as you said. It made me think about something that happened back when I was doing a proposal one time. I had a firm that I felt like they were going to use us as their M&A advisor. It made perfect sense for them to, but they ended up going with someone who offered wealth management advisory services, which I thought was rather strange because I'm thinking, okay, I wouldn't use Jeff Adams for wealth management advisory. I was trying to figure out why they would use a wealth management advisor for mergers and acquisitions. Any thoughts on that?
Well, the uh, the importance of having a team of people giving you advice at the time of a transition, I mean, it can't be overstated. I'd say some of our scariest moments are when business people approach us and say they've arranged to sell a business and they haven't engaged a CPA or an attorney or brought anybody's attention to the matter.
Mm.
But there are some critical components to a transaction that professionals can provide. Number one is there's tax considerations at any transaction that if you're not lining everything up properly, or for that matter, documenting a sales agreement properly, you're leaving money on the table. Um, and then two is just the marketplace in general. Like, what's your company worth? Are you getting a fair value for the company? And how does that valuation present itself if you had multiple buyers or one or two more people bidding on your business? But in general, um, the context of working with a team of people, and that doesn't necessarily mean that a wealth management firm is first in line. In fact, I would argue that probably the CPA is absolutely the first person you need to contact to get a preliminary review of what does a sale look like. It's not like a wealth management is necessarily the last person, but a wealth management advisor can help you in the transition. But reality, they're going to help you for 20 or 25 or 30 years of taking the proceeds that you're getting from that business and living on them, making charitable goals realistic, making family wealth transfers realistic, etc., while still all meeting your retirement and income goals. Um, I would tell you that our experience working with small business owners, one of the biggest things that we can help them understand is that the private markets and private businesses are valued a lot different than the public markets.
Mm.
Sometimes the hardest thing to see as a business owner is 15, 25, 35 years of work on a piece of paper that shows up once a month called an investment account statement, and seeing the fluctuations in values that probably were there before but just aren't existent like they are when you get a brokerage statement delivered to your front door every single month. That plus the realistic amount of cash flows that can actually come from money that's invested in the capital markets is generally considerably lower than a private company. So all of those components of preparing for a sale and engaging a team of professionals and a wealth management person to help you prepare for that transition. So that's quantitatively and qualitatively, what does life look like when I'm no longer a business owner? That's something we're accustomed to doing frequently. We've done it several times for many business owners.
Just to add to what Brian said, I mean, it was, man, back 3 or 4 years ago when interest rates were zero, it was incredibly challenging to meet with a business owner and they're like, okay, I'm going to sell my business for X. How much income can I get from my portfolio? And you're like, well, it's about zero. So, we really have to help them understand, what's a proper withdrawal rate and where is the income coming from. Thankfully, we're back in kind of a normal interest rate environment, but it is still really difficult for business owners. I mean, if you put your business up for auction every minute of every day, you'd see a lot of price volatility, kind of like the stock market. It is very, very difficult for them to sometimes grasp that when the bulk of their net worth shifts from a private company into more liquid investments.
Absolutely, and I imagine that certainly comes as a shocker to a lot of owners when they're making that transition and trying to get accustomed to that. And I think, Brian, that's what you were kind of saying with the um, You're used to having a monthly P&L statement that, kind of tells you about the performance of your business and what's going on. You get an annual valuation, maybe in some cases you don't when it's your firm, versus getting your money put into the stock market, what have you, where you have these statements that are coming out that are based on a variety of different factors that are driving the valuations. What kind of challenges, if we could dig into that a little bit, what kind of challenges do you see people having? Maybe people that have been business owners that are making that transition now to where they're not in control of the business that was driving the value, but now they're become more, let's call it, passive investors.
Yeah.
Yeah, I would say one of the most complicating factors, and I don't know how to say this other than just to say it, but you're no longer necessarily the person making all the decisions,
Mhm.
and you're having to report to somebody, and you're having to answer their questions. And some buyers' questions are, at least appear to be more urgent than others, and they want information that you never thought was important, and they're constantly saying, where's this, where's that, how come that's not here? So it is a challenge moving from being a private company where you or family members or whatever are the ones making decisions and asking for information, to having to deliver information on a periodic basis. That's especially true if you're engaged with an entity that's a public entity, because of the quarterly cycle of information flow, et cetera, that has to happen. If your business is sold to somebody who is a public company, that's a significant change of pace and just a change of information flow. I'm not saying that's right or wrong, because you very well might have every one of your financial goals met, but that is definitely a challenge on the other side of a sale.
One thing I think about or you reminded me of there, Brian, is that when I was the CFO of a civil engineering firm, we ended up selling our firm. We actually had an advisory board that our founding CEO, had the um, foresight to actually bring them on to get an external opinion on how the company was performing. And, I think one of the in addition to helping us become a better company and be more well-rounded in how we look at things, it kind of gave us that introduction to having an outsider questioning what you're doing.
Mhm.
And I think that, so I gave a side benefit when we ultimately sold the firm to another buyer. It wasn't the first time we were hearing questions from an outsider.
We actually have an advisory board for our practice that we utilize in much the same way. And it's been incredibly helpful. I mean, it's helped us make a lot of business decisions. And one of those decisions that I think it helped us come to was how we want to transition our own business. I think one of the biggest mistakes people make is not planning well in advance of their business transition. I mean, the only times I see people not maximizing the value really is through not planning at all. And through these advisory board meetings, Brian and I have personally spent a lot of time figuring out how we want our business to transition. Private equity is massive in the financial services industry at this point, and obviously we could choose to just maximize our payout. But we actually chose an internal transition process over an extended period of time, and took years to work on that. And because of doing that, we get to take out of our business what we want, which is not necessarily maximizing our own profits. For us, it wasn't about maximizing money; it was about maximizing flexibility and lifestyle, and the ability to continue working through the organization as we kind of transition from our leadership roles. That all came from the advisory board, really. That all started that kind of discussion.
Yeah, that's a great point there, Jonathan. And when we're working with firm owners, AE firm owners thinking about transitioning their business, I'm still surprised the number of times I'll have someone come to me that's in their 60s, mid 60s, sometimes even approaching 70. And they're like, hey, thinking about transitioning my business. And I'm like, you go to an industry event, whether it's a ACC or AIA, they're both talking about and have been for years about the importance of making those preparatory steps, right? And because it takes time, you can't just flip the switch. I mean, we tell people if you're doing an internal ownership transition, you're looking at 7 to 10 years to pull that off. M&A can be done a little quicker, but 3 to 5 years is a good frame to think about it, just from the process of going to market. Plus, the buyer is going to want you to stay on board for 2 to 3 years, ideally. So, I think so many times firms think, "Hey, I'll just keep the cash cow going, right? Keep taking the money every year, being in charge,
Mhm.
and then when I'm ready to be done, then I'll sell it then." But from our standpoint, the valuation is not as strong if the founding owner is going to exit the building as soon as they sell the firm.
Definitely.
I don't, from our perspective, you don't get the best complete comprehensive value for everything when you do it that way. What's your perspective? I'm interested in hearing that from a wealth management advisor perspective.
Well, from our perspective, we attempt to very early on identify risk, and risk can be present in a lot of different ways. But I do believe that business owners who properly plan for uh, a transition at some point down the road have effectively de-risked themselves financially. Every industry, every business, every company has its own unique risks. And if you can be um, open about those risks and aware of those risks and start planning for those risks, you can de-risk your transition well in advance. Even if you have an external risk, or I'm sorry, even if you have an external transition, you could be de-risking your exposure to that transition 7, 10, 12 years in advance by setting things up properly and at least having a game plan on how to do that. One of the ways that we attempt to do that through our planning with business owners who aren't in the transition period is through corporate retirement plans. When you properly set up a corporate retirement plan, whether it's uh, a company that has high or low capital requirements, when you're setting up those plans and you're effectively distributing profits into this other bucket, so to speak, and you're investing in whatever, you should be investing in a de-risking formula. You should be investing such that you're taking industry specific risk off the table by accumulating wealth in whatever bucket you can put it in, whether that's a pre-tax bucket, a cash balance pension plan, a Roth bucket, etc. That's one of the ways that we have helped set business owners up for transitions well in advance. I don't know, John, do you have something else you're thinking of? Or
Well, not to mention, I mean, the importance of establishing a leadership team. Um, I think a business is worth a whole lot more when there's an infrastructure and it's not dependent on one or two people to
Hmm.
run. And oftentimes we'll have to include non-qualified plans as an incentive to keep people on and keep the leadership in place through the business transaction
Mhm.
ultimately.
Yeah, no, that's great, guys. And let's step back a minute, though, Brian. What are some of those risks? You mentioned risk, and de-risking. What are some of those risks you're talking about?
We were the beneficiary of receiving the proceeds of a sale of a company who basically sold imaging and copiers and technology solutions through. Had been built up basically in the 90s and early 2000s. Well, there's not a lot of paper being copied and printed anymore. I mean, there's less and less every single day. So that business radically transformed since this gentleman started it. And I mean, maybe he could have had the forethought 20 or 30 years ago when he started the business, but technology is an absolute force in changing how people do things. And we don't know where AI is leading or going to, but it's going to have an impact in 20 years. So if you aren't de-risking your business from a technology standpoint, that's absolutely important. Um, Labor factors, you know, uh, factors related to trade, international trade, or domestic trade, or even trade across our north and south borders. Like what's
Mhm.
going to happen in the next 90 days? Nobody really knows how that's going to play out. And if your business hasn't de-risked, or you haven't considered ways to de-risk some of those exposures, um, your business value could suddenly be changing at the time you want to stop working or you want to transition, and you have nothing set up on the side to provide for your financial goals in the future. Yeah, and I can't help but say, like, maybe our job is evident, maybe it's not, but everything in my job is either it's red one day, or it's green the next day, or it might be green. It might be green 3 days in a row and red 4 days in a row. And John and I were in the business in 2008, 2009, when everything was red, not for a day, but for like months and months at a time. And literally the questions of the capital markets and their infrastructure were sort of melting apart from the inside. I realized very quickly that everything I owned had a very high correlation to the stock market, and I needed to do something different. And there was a lot of ways that I personally did it. It doesn't really matter what I did, but I tried to diversify my own personal finances away from stock market correlation of one. So we're attunely aware of how to maybe identify risks and find ways to de-risk for business owners, but to count on your business to provide for a large lump sum at the conclusion of your career to be exactly there as you plan, that is risk. And it might work, it might not
Mm.
work. And that's what we're trying to say is a properly set up transition doesn't happen 30 days before. It happens, you know, 13, 15 years before, by just prudently taking small steps to get to that transition point.
And Brian makes a really good point about 2008. And in fact, I mean, we have taken steps to diversify our business lines so that we don't get into trouble if that sort of environment occurs again. There's also just leverage. I mean, the natural tendency of people is to be super confident when things are going great, and super pessimistic when things are going poorly. When in reality, we should be thinking the exact opposite way. Um, so, when we see people leveraging themselves to the hilt at the peak of the business cycle, that's problematic. And that's part of, I think, our role with clients is to help them understand what level of risk they're taking on by doing this, especially, as do businesses peaks and valleys. Um, of course, we really haven't had a business cycle for 15 years now.
Yeah,
I'm sure
absolutely. Mhm.
I'm sure we'll have one again someday. And that's really the problem that we have right now is, our government has effectively removed the business cycle through fiscal and monetary policy
Mm.
to the point where I think people are beginning to believe that there is no such thing as risk. Risk is not gone. I mean, in fact, I would say that this prolonged environment without a business cycle, other than like a 1 month recession during COVID, that to me is tremendously risky, and it probably is a great time to start thinking about risk and maybe kind of leverage you're utilizing at this point.
Yeah, I'm glad you brought that up too, because it's. I mean, 2008, 2009 was really the last time, right? We saw that huge downward spiral, and I think for years we were all saying, "Okay, we're due one," and
Mm-hmm.
it just never came. And the government did kind of has helped mitigate that for good, for bad, to be determined. What are your thoughts? You're the expert. So when you think, what are you telling your clients right now when you think of 2025 and what's coming down the road and this pressure that's just kind of built up? One thing I hear people saying, they look at the metrics out there, and there's no clear story, right? Some tell you, hey, it's going to be rosy and great. Others tell you, ooh, it's looking a little scary down there. But what the common theme you hear from people is this is not sustainable.
Mm-hmm.
So, what are your thoughts on that? What are you telling your customers?
Well, I would say one of the biggest misconceptions about working with a wealth management person is that we know exactly what's going to happen next, or the next big growth stock or the next big tech stock. We know a lot about the markets, but we're not clairvoyant about predicting what's happening next. What we know a lot about is we identify risks very quickly, very easily. We know how to tax efficiently use wealth over decades. We know how to most efficiently set up for your charitable goals, for your wealth transfer goals, etc. We know strategies that work over longer periods of time, but it's very difficult for us to predict what's happening in 30, 60, 90 days. But to think that the conditions for this administration are identical to the last time this administration or this president was in charge of our country, the complete business environment has changed. And to think that we can just replay what happened in 2017, 18 over again in 2025, 26, I don't think is a proper conclusion. We don't know where this administration is going to lead us in terms of tariffs and tax cuts or tax policy going forward, but knowing where we are in the business cycle, where we are in the fiscal cycle, should you be taking income realization today versus income realization in 5 or 8 or 10 years. Those are things that we can say history suggests that acting now is probably going to be good as opposed to trying to act 10 years from now. I don't know if that's what commonly people hear from wealth advisors, but that to us is where we can absolutely add value to an equation. And we invest well, but we don't invest that generates returns 5 or 6% better than the market. But we're very attuned to trying to describe where a transaction sits in time and space related to taxation, related to fiscal policy, related to monetary policy, related to all your goals, et cetera. I think we do a very good job of placing that individual in that time and space and making sure they're making the best long-term decisions. I don't know, John, do you have something else that you're thinking?
Yeah, no, I have to agree with you, especially on the part where we can't predict the future. It's what I can say is it's much easier to predict the next 10 years than it is to predict the next 1 or 2 years. And it's remarkable when you think back to 23 and 24. 2022 was a horrible year for the markets. I mean, we had inflation that we hadn't seen since the 70s. We had the Fed, aggressively raising interest rates, probably a little too late, if I had to guess. And then, going into 2023, everybody was super bearish. Everyone thought inflation wasn't going to go away. Going into 2024, everybody thought we were going to have a recession. None of those things happened. Markets did great. And now I think one of the biggest risks, and I know that, sort of impacts the private markets as well as the public markets, but one of the biggest risks now is as people are selling their businesses and making some assumptions about the future, I think that they'd be making a big mistake to assume that the future is going to be like the last 15 years since the financial crisis. It's been a very unique period of time. And most of the major firms out there, and I'm not saying that we're this bearish because I don't think we are, but you look at the Vanguards or Goldman Sachs of the world, and I think they're looking at maybe mid-single digit returns for the domestic stock market at best for the next decade. Again, I'm not saying we agree with that. I'm simply saying that the expectation going forward is very different than the past, and if we're making projections and plans based on the past, it's probably not a very good idea.
Yeah, I definitely think people that have entered the stock market since the 2008 timeframe probably have this misconception that it's a guaranteed win all the time, and they've seen some hiccups along the way, but the trend's always been positive, and they didn't go through what a lot of us went through in 2008, 2009, and experiencing that. A while ago, Brian, you mentioned a misconception people have about what wealth advisors do, thinking, maybe, some secrets about the market or some insider trading, if you will, or whatever, that what's going to happen and have a crystal ball. What are some other misperceptions that you see people having about what you guys do?
Well, I think that most people perceive us as being quantitative only advisors. In other words, what's the rate of return? What's the tax rate? What's the whatever number, which we are. Incidentally, I am a MECE major by by engineering, so I'm highly attuned to numbers and analysis, etc. But part of wealth, and especially family wealth, has to do with qualitative things like families. How do families handle money? How do you raise kids with a lot of money in your stock market or in your bank account, or how do you make sure that the next generation understands the value of money and doesn't just have some expectation of money, etc. So it's not like we have a perfect answer, but what we do is we consult and we talk to families about how to handle family dynamics, etc. We also talk about just investor psychology and how to handle sort of the ups and downs of markets, movements, etc. And try not to buy things when you get a tip from your barber at the barber shop that the next XYZ is the best way to double your money. In other words, it's intangible things that, because we've been in the business for 25 years, we've had people sell businesses. We've talked to them through thick and thin about best ways to preserve and grow wealth modestly going forward, that we're pretty comfortable talking about more than just numbers.
Yeah, I would add that the amount of information that people have it's like drinking from a fire hose. When you're like, there's so much on the internet. There's so many newsletters, and there's, as Brian said, the stock tips from your barbers, or in this case, these days it's the 17-year-olds on Robinhood who want to tell you what stocks to buy, and they've probably been right for the last few years, actually. But it's an enormous amount of information to sort through, and our job is really to help them figure out what's right for them, because the answer is not the same across the board for everyone. And as Brian mentioned, family dynamics are incredibly important when you're dealing with a large amount of wealth, and the decisions that you make during your lifetime have a huge impact on everyone after your lifetime. So that's I think a big job of what a financial advisor does. I think that frankly, people sometimes ignore the fact that taxes take away from returns. A lot of people are seeking the best possible returns, but maybe not the most tax efficient returns, or the best possible returns, but maybe not the best risk adjusted returns. So our job is certainly to understand that, and to really just try to control the tendency of investors to be, again, super optimistic and positive at peaks and super pessimistic at valleys. And Warren Buffett, obviously one of the best investors of all time, it is very famous for sitting on piles and piles of cash until, as he says, there's blood in the streets. The average investor over time, there's lots of stats showing this, makes far less than the market, because of their decisions during economic peaks and valleys. So, I'd say behavioral psychology is a huge part of what we do. And as Brian's a MECE major, I'm actually a psychology major. So.
Hey, that's a good combination.
Yeah, absolutely.
One item that I thought about while John was chatting is, I'm not going to say it's a misconception, but I think one of the things you should absolutely depend upon your financial advisor or your wealth manager to help you with is looking at, and John alluded to this and so did I, but looking at tax consequences over multiple years. I'm not begrudging the advice that you get from your CPAs, but CPAs often have a tendency of, don't pay a tax today, pay a tax tomorrow. And sometimes if you're looking at aspects of how our government's being run and deficits, et cetera, it actually does make sense to pay taxes sometimes sooner than later. And one of the benefits, if you have a transition and you have after-tax proceeds from selling a business, is you set yourself up for tremendous flexibility on wealth utilization over a period of time prior to, say, age 70 when Social Security begins, or when we generally recommend people to start Social Security, or age 75 or 73 or 75 when RMDs are required from retirement accounts. You have a significant time flexibility in there to use your wealth in creative ways so that you can prepare yourself for the best 15, 25, 30 years worth of tax, after tax returns, et cetera. So I think it's not so much a misconception, but I absolutely think that that's the role of a good wealth management advisor, is to give you that type of guidance and direction.
Yeah. Let me add one more thing. Oh, go
Sure.
ahead. I'm sorry.
No, go ahead.
Well, I'm thinking about one of my largest clients who was in the AEC industry and sold a business probably 5 years ago, and it's a little frightening. I mean, he got a massive lump sum of cash, more than he can ever spend in his entire life, and imagine if you sell your business and in the first year you're aggressively invested into the stock market, and a third of your net worth evaporates.
Mm.
That is, I would say, just understanding risk, understanding how to mitigate risk, understanding in some cases how to hedge against risk is incredibly important, because a decision to take the wrong amount of risk immediately after having your liquidity event has lasting consequences, and you certainly don't want to go back to work. So, that is something that we deal with, and maybe sometimes I'm conservative to a fault, but the psychological aspect of having a major loss after your liquidity event would just be devastating for people.
Yeah, I can't imagine where, you just had this wonderful deal got put together. You got a high multiple of earnings on your firm, feeling really good about that. You throw it in the stock market and kaboom.
Yeah.
Yeah. That probably that was probably some difficult conversations you had to have if you went that path, right? And working through it, but it happens. That's reality. I mean,
Does.
that's right. Like you said, you guys don't have a crystal ball. You're helping mitigate risk, and had you not been there, it could be even worse.
Right.
Right. I was thinking about when you were talking a while ago that the common just gut instinct that we all have is we all want to buy when the stock market's going up, and we all want to sell when it's going down, right? That's the psychology of it. But you guys would say, well, you actually should flip that the other way around, I think, and
Yep.
Yeah.
buy when everybody else is selling and sell when everybody else is buying. So,
Or one of the things that I think we do well is, if you can plan properly and set up some cash flow projections, et cetera, you can identify the percentage of your wealth that you're realistically going to use over your lifetime. And you almost have a barbell perspective. Like, I can be very conservative with the bucket of money that I need for mine and my spouse's lifetime. And then I can be very aggressive with another bucket of money. And then we further identify, if you're going to be aggressive with a bucket of money, what's the best bucket to use. Like, in other words, if your overall allocation or pie chart looks like this, whatever that is, it doesn't necessarily mean that each account has that identical pie chart. You can have a very aggressive approach with, say, your Roth dollars, a very conservative approach with your pre-tax dollars, and a balanced approach with your after-tax dollars, which is what you would receive your money in from a transition or a sale, all of it being planned properly so that your utilization of your dollars are there as you need them for your lifetime goals, but optimize your risk posturing in which bucket that the risk is actually being taken. So,
well, based on the conversation thus far, I think I know the answer to this next question, but I'm going to ask it anyhow. If someone is considering selling their firm, when is the right time to involve a wealth management advisor?
I would say, you should be involving a wealth management advisor from the day you set up your firm.
That's what I thought the answer was going to be. I thought you'd say yesterday. So,
Yeah. And, selfishly, from a business standpoint, one of the main reasons that we enjoy having corporate retirement plans as a very large niche for our practice is That allows us to get in front of business owners very early in their careers. And it's great because you get to know them very, very well when it becomes time to sell and have that liquidity event. But, Brian alluded to the creditor protection of corporate retirement plans before, and just the fact that you're diversifying out of your business over time. Using corporate retirement plans to help, attract and retain employees is a big deal. I think sometimes people view those as almost a just necessity, something they have to have just to check a box.
Mm-hmm.
But if you utilize it correctly, it's an incredible tool for attraction and retention of employees.
Yeah, I was going to say we've actually set up internal family transitions using defined benefit pension plans because when you're transitioning and you're basically redirecting profits, you can discriminate amongst family members. So if you have, father son, father daughter, mother son, whatever it is, and you're trying to transition a business to the parent, and the child is on payroll and working for the company, you can discriminate against that person from actually receiving benefits, and then you can super load up the parent with benefits, profit benefits, effectively, so that you're effectively creating an internal tax efficient transition that allows the parent to retire, the child to end up having control of the business, and all along you're creating a creditor protected bucket for the parent to live off of. That's effectively de-risked from the business strategy or the business risks or the industry risks of the business. So a lot of flexibility. The sooner we can get engaged with a company, and it's not like you need to plan on having a sale the day you start a business per se, but you should really be spending some portion of your time understanding, like, how is this playing out? And by the way, it doesn't matter if you change lanes. If you have a base case scenario of this is going to be an internal transition, and then your child grows up and like, Dad, I got nothing to do with your business. Like, okay, fine. Then now it's an external transition. But the bottom line is start with the end in mind ish, in the sense, like, start planning and thinking about what it means on the back end of your business establishment is good. Yeah. So yesterday or the day you start or whatever you want to say,
Yeah.
it doesn't hurt getting some ideas and advice early.
Well, we say the same thing here. Start with the end in mind when we're developing strategy, helping firms develop their business strategy. We talk about that from an M&A viewpoint. And actually, I think I had a webinar on that topic because, I think it's important for firm owners, even if they're going to be buyers, acquirers of firms, know your end game.
Mm-hmm.
Who do you want to be for what purpose at some point in the future?
Yeah.
And that helps define what today's strategy looks like. Same way you guys are talking about, right? And how you manage your money and de-risk yourself to prepare for that future. And and I think that's one of the reasons Stambaugh Ness recognizes that. And we recently partnered with you guys, entered into a sort of partnership with you guys to help bring that kind of service to our clients, that because we know they need them. There's a lot of AE firms out there that need that kind of service, and you guys do a great job of it. If somebody starts working with you, an AE firm owner here, whether they're looking to sell or not, you've talked about a lot of different things of what you do today, but what should somebody expect you to start doing like day one?
Day one is understanding where you are in your goal realization. Like, if you haven't identified what that long term or end process is, day one is like, tell us, like, what's your timeline, what's your goal, like, what are you thinking, etc. And then incorporating in the advice of in discussions with the CPA about current business ratios or dynamics or whatever in terms of the business. But yeah, and starting can be a one person shop or a 10-person shop or a 100-person shop. It really doesn't matter. Starting with a conversation to begin the process of, like, this is what this could look like in 15, 20 years, et cetera, is perfect. And that doesn't necessarily mean it's an engagement with us. It could be just a conference or a consultation and a discussion with the CPA on Stambaugh's staff, which is like, hey, can we spend a half hour, an hour talking about some things to build or to consider today if a transition's happening in 10 years? Sure, absolutely. We've got a lot of great relationships with and from the Stambaugh Ness accounting team, and we look forward to many, many, many more. And the AEC industry is certainly one that we have worked with locally, and some national experience with your firm as well.
Yeah.
Yeah.
Go ahead.
Well, I was just going to add, and really reemphasize Brian's point about working with the client's CPA and attorney. In many cases, I kind of view us as the quarterback. We don't do taxes. Frankly, we don't do valuations. You should be taking the lead on M&A discussions. We don't do legal documents, but we know an awful lot about these things, and we can do a great job in kind of helping the client come to some conclusions, while working with their CPAs and their attorneys. And the other thing I wanted to add really to that is I think it's always important to think about, again, from a risk mitigation standpoint, what if tomorrow I'm physically not capable of doing my job anymore? What if tomorrow I die? And coming up with those, situations, and what exactly would you want to have happen if this were the case?
Mm-hmm.
That really is our job from day one, working with the client.
Yeah, and I will add, the two guys you're looking at had the exact same discussions about our exact business and what happens if.
Yeah.
And we've done it internally, and we've done it and helped people externally. So yeah, we don't write legal documents, we don't sign tax returns, but we read both of them, and we do a lot of it. I mean, we don't do a little bit of it; we do a lot of it. So we have the insight and the ability to say, "Have you considered these things?" Or "Let's get on the phone with your CPA and talk about these things." In fact, I just emailed a client this morning. I just emailed a CPA this morning about a business that has gotten to the mature stage. Like, hey, it's time to really start considering setting up a retirement plan, but I want to know from you, what are the impacts of changing aspects of how they receive compensation, et cetera, to get a retirement plan set up. It's not something we just want to do in a vacuum. We have to do it in consideration of a lot of other factors.
Yeah, that's great, guys. I mean, I can really sense how you partner with firm owners out there and customize your approach to fit their needs. But I see so many similarities in your approach to wealth management, our approach to M&A and strategic planning, and other services that we provide at SN, where we're really trying to understand first and foremost what's our clients' goals, what are their objectives, and then that determines what all we're going to do in the process. And I love how you laid out the partnership there, that it takes a team of people, right? Just like I said at the beginning, I don't know wealth management advisory. I can't advise people on that. You guys don't do M&A, right? But together, we're there guiding our clients and creating the best of both worlds. I should say, back on that earlier analogy, or earlier example that I put out there, that client ended up not being happy with their wealth management advisor that for their M&A portion of the services. The deal did not go well, and they ended up reaching back out to us to get some assistance. But it's this has been a great conversation. Before we close, is there anything you would just like to tell the audience? Just parting words.
Oh boy.
Yeah.
Well, your turn, Brian.
Yeah. First of all, John and I are both the managing directors of this company. We've known each other and worked together for 20 some years. He's as close to me as my brother. So together, we have worked through how to establish, build, and work on a transition plan for ourselves. And in the process, we've had the exact experience that your clients or your potential clients are having. Maybe different dollars, add a zero, take a zero. It really doesn't matter. It's the same concept, the same topics. We've written operating agreements. We've talked through what happens if scenarios. We have created, ways to de-risk ourselves from our own business. We've added lines of business that end up de-risking ourselves from traditional stock and bond market fluctuations, etc. So our own personal experiences lends credibility to working with other business owners, but it's not like we're unique in that. There's probably 1,000 advisors who have done that, but just be aware. 1,000 advisors around the country that have done that, but just be aware of the experience and the advice you're getting from the people you're depending upon. Certainly, your team and Stambaugh Ness is instrumental, have done a lot of deals in the industry. But if you're relying upon a wealth management advisor to do or to provide advice for you in a transition, just seek that background or that experience. I don't know, John, do you have something else? Or
Yeah, no, I agree with everything that you said. I would also say, while we have the experience here internally because of the type of business that we run, and frankly, there's just a lot of similarities between all businesses, especially professional service firms. We've also made our fair share of mistakes, and we've learned from those. And that, working together for 23 years at this point, first of all, most partnerships don't last anywhere near that long. But we've successfully worked together for 23 years, and we're still talking to each other. We've added four more partners, and are still functioning as a cohesive unit. And we've made our fair share of mistakes. Thankfully, none of them terrible mistakes, but I'd say they were very positive mistakes, and that we learned a tremendous amount, and it helped shape our practice. It helped shape what we're doing going forward. So, yeah, I mean, that type of experience and advice specifically for business owners is really important. I'd say, don't just go with the person who's offering you the best returns, because no one can predict where the best returns are coming from next. I'd say go with the person who's going to understand you and your goals and your family, and understand your business. That's going to be the recipe for success.
Uh-huh. Excellent. Well, John, Brian, thank you so much for joining me today. Scripted Mergers and Acquisitions Edition. I'm Jeff Adams, and it's been a pleasure guiding you through M&A from the perspective of a couple of wealth management advisors. Please remember to subscribe and leave us a review wherever you get your podcast. And until next time, keep pushing forward.